It's mid-December, and this is the part of the year when the market can feel like it's running on equal parts fundamentals and adrenaline. You've got year-end positioning, window dressing by funds that want to show winners on their statements, tax loss harvesting that dumps laggards, and the classic Santa rally mindset where people start leaning risk on just because the calendar says so. In that kind of environment, momentum stocks, the names already attracting heavy attention, and fresh buying can make their sharpest, fastest moves. Quick disclaimer before we start: this is educational content, not financial advice. Do your own research and know your risk. Now, here's the simple framework I'm using today. A true momentum stock usually has three things at the same time. First, a story investors can repeat in one sentence. Second, real fundamental traction, revenue margins, cash flow guy, and something you can point to that says, this isn't just vibes. And third, a chart that proves big money is willing to pay higher prices even after pullbacks. When all three line up, the stock doesn't need everyone to agree with it. It just needs enough incremental buyers, enough FOMO, enough "I can't be underweight this" energy to keep pushing price higher. With that in mind, here are two momentum setups that, based on what we know right now, have a legitimate shot at making a big move into year-end if the market stays risk-on. First up is Tesla, ticker SLA, because love it or hate it, Tesla is one of the strongest momentum magnets in the market right now. On Tuesday, December 16, 2025, Tesla closed at a new record high near 490, specifically 489.88, and that move was tied to renewed excitement around its Robotaxi progress and the self-driving trajectory. As of today, December 17, 2025, Tesla is trading in the mid-470s intraday, which is exactly what a high momentum name often looks like. It rips to new highs, then breathes, but stays elevated because buyers don't fully let go. Here's Tesla's one-sentence story that's pulling money in. Tesla is being repriced less like just an EV maker and more like an autonomy and AI platform with meaningful upside from robotaxis and robotics. You don't have to personally agree with that rating for it to matter. Momentum is about what the market is doing, not what the market should do. And right now, the market is reacting to autonomy progress like it's a catalyst that can move the timeline forward. The headline that's been driving the latest leg is the idea that Tesla is testing fully autonomous robotaxis without safety monitors. And that's exactly the kind of development that can snap investors out of someday thinking and into this could happen sooner than we thought thinking. In momentum land, the difference between "we're improving the system" and "we're testing without safety monitors" is huge because it implies confidence and iteration speed. And iteration speed is what investors pay up for when they're chasing big future markets. Now, let's expand why Tesla could keep running into year-end without pretending we can see the future. Momentum often continues when investors are repricing optionality, meaning they start paying for upside scenarios that were previously treated as distant or unlikely. Robotaxi is the ultimate optionality story because the business model is not sell a car once. If a robotaxi network ever becomes real and scalable, the story starts to look more like software economics and recurring revenue, which can justify very different valuation frameworks. That's why Tesla can move hard on perceived autonomy progress, even if near-term vehicle sales trends are debated, and even if Wall Street sentiment remains mixed. In fact, when you have a stock ripping while plenty of analysts and investors still aren't fully bought in, that can be fuel because it means there are still skeptics left to convert, and every conversion is a new buyer. Another reason Tesla is a year-end momentum candidate is mechanical. Tesla's options market is enormous. When options activity heats up around a big headline, short-term moves can be amplified by hedging flows, and those flows can create a feedback loop where a strong up move forces more hedging, which can add buying pressure, which can extend the run. That cuts both ways, and it's not guaranteed, but it's one of the reasons Tesla can move more than people expect, especially into year-end when liquidity can be thinner and price can swing faster. The "what would it take for this to feel like a year-end melt-up" question comes down to two things. Does the stock hold its gains after the headline spike, And does the news flow stay constructive? Momentum names that are truly under accumulation don't just pop and collapse. They often pop, pull back modestly, then build a higher base as buyers defend levels. If Tesla can absorb profit-taking and stay above key areas, the chart stays in control. On the news side, anything that adds credibility, expanded testing, clearer pilot details, credible timelines, or even just a steady drumbeat of progress instead of problems can keep attention locked in. But let's be honest about the risks, because Tesla momentum comes with real landmines. One big risk is regulation and liability. Even if the technology improves, scaling autonomous ride-hailing city by city is not just an engineering problem. It's a policy, legal, and public trust problem. Another risk is classic, sell the news. Especially late in the year, when a stock prints record highs, plenty of traders are sitting on big gains and looking for an excuse to take profit, and late December price action can get jumpy. And there's always the underlying tension. The stock can rip on autonomy optimism while the broader business still faces real-world demand and competitive pressures. So if you're watching Tesla as a year-end momentum setup, the mindset is treat it like a setup, not a prophecy. You're not predicting Tesla will skyrocket. You're observing whether the market continues to reward the autonomy narrative. Have a plan for what would make you wrong. The stock stops holding higher lows, break support on heavy volume, or the news flow shifts from progress to pushback. If those things happen, momentum can fade fast. If they don't, and the stock keeps consolidating constructively while headlines stay supportive, Tesla remains one of the most explosive attention trades into year-end. Now, let's get to the second momentum setup. Palantir Technologies, ticker PLTR, one of the most relentless trenders of 2025. As of today, December 17, 2025, Palantir is trading around the low 180s intraday. On pure momentum, Palantir is up massively year to date in 2025, and that kind of sustained relative strength is exactly what keeps institutions engaged and keeps late buyers chasing. Palantir's one-sentence story is simple and powerful. It's a data and AI software company sitting at the intersection of enterprise AI adoption and government or defense modernization. The key is that it's converting that demand into rapid growth and rising profitability, not just headlines. That combination is why momentum traders and longer-term institutions keep coming back. The fundamentals here are not vague. Palantir's recent results showed strong revenue growth and solid earnings, and just as important for momentum, the company raised guidance both for the next quarter and for the full year. That's the fundamental traction piece. When guidance is being raised and growth is accelerating, investors feel more comfortable paying up, even if the valuation looks scary. Now, Palantir's momentum is being powered by two giant tailwinds at the same time. Tailwind 1 is enterprise AI adoption, where companies want tools that deploy AI into real operations, not just experiments. Palantir's US commercial business has been growing rapidly, which matters because it tells the market Palantir isn't only government anymore. It has a commercial engine that can scale and broaden the investor base. Tailwind 2 is defense and industrial modernization. And here's where Palantir just got a very fresh, very specific December catalyst. In early December 2025, the U.S. Navy announced a major strategic investment tied to an AI-enabled operating system for the shipbuilding industrial base, and the announcement stated that the effort will leverage Palantir's software. That's not just a headline. It's a signal that Palantir's platform is being pulled deeper into critical infrastructure workflows. And the most momentum-friendly part is that the Navy's public communication included hard performance metrics from pilot deployments. The metrics pointed to dramatic reductions in time required for planning and review workflows, collapsing processes that used to take days or weeks into minutes or under an hour. When a customer puts that kind of before and after improvement out publicly, it strengthens the case that this is not AI theater, it's measurable productivity, which is exactly what enterprise buyers and government buyers want. So why does Palantir have a credible year-end rocket fuel setup? Because it checks the momentum trifecta: The story is easy to repeat: enterprise AI plus defense modernization, while the fundamentals are improving with strong growth and raised guidance. And there's a fresh catalyst that reinforces the narrative through expanded adoption in a high-visibility government modernization effort with measurable outcomes. If the market stays in a mood where it wants real AI revenue and real contracts, Palantir is one of the clearest beneficiaries. But we also have to be realistic about the risks, because Palantir is a high multiple momentum stock, and those can be unforgiving. High multiple names can gap down on any disappointment and earnings miss, a guidance cut, or even just a quarter that's good, but not great. Another risk is momentum fatigue. If the market rotates away from AI leaders into value, defensives, or something else, Palantir can stall even if the business continues improving. So if you're watching Palantir into year-end, you're looking for confirmation rather than assuming the trend will carry itself. In price action, confirmation looks like the stock holding higher lows on pullbacks and getting bought on dips instead of cascading lower. In fundamentals, confirmation looks like continued strength in U.S. commercial growth, because that's the segment that supports the scalable platform multiple. And in the narrative, confirmation looks like continued wins that are specific new programs, expanded deployments, measurable outcomes, rather than vague AI marketing. The more concrete the proof points, the longer momentum tends to stick. Now, you might be thinking, okay, these are already big winners. Doesn't that mean I'm late? Not automatically, because momentum tends to run in waves. First the stock turns, then the story spreads, then the market re-rates the company. The key is recognizing which wave you're in, and whether the trend still has fresh buyers to pull in. Tesla's current wave is the autonomy narrative intensifying around robotaxis, with the stock recently printing record highs. Palantir's current wave is enterprise AI adoption accelerating, while defense modernization headlines keep validating the platform. That's why these two make sense specifically as year-end momentum watchlist names. They're not relying on a distant, hypothetical catalyst. They're already in the middle of an active, market-moving narrative. So here's the practical takeaway for the final stretch of 2025. If you want momentum setups with a plausible path to a sharp year-end move, you look for stocks where the next headline could reasonably be positive and where the market has already proven it will respond. Tesla fits that because the autonomy and robotaxi story is developing in real time, and it just hit a record high. Palantir fits that because its AI-driven growth has been accelerating, it raised guidance, and it just landed a high-profile modernization catalyst tied to measurable productivity gains. But the most important reminder is this: momentum is powerful, but it's not mercy. The same force that pushes a stock up fast can pull it down even faster. If you choose to participate, manage risk like a professional, size appropriately, define what would make you wrong, and don't confuse a strong narrative with guaranteed returns. There's a difference between set up to run and will run, and the market humbles anyone who forgets that. If you enjoyed this breakdown, hit like, subscribe, and comment SLA or pleader with the one key reason you think it has the better year-end setup, or tell me why you think both are overextended. Either way, stay sharp, stay disciplined, and I'll see you in the next one.